Hi, today I'm going to talk about how AI companies differ from SaaS from a financial perspective. Let's say your AI company just hit $5 million in ARR with 80% gross margins. That sounds like a great SaaS business, right? Wrong. When investors dig deeper, they discovered that your real costs were hidden. Your revenue was not recurring, and your unit economics were completely different from traditional SaaS. I've analyzed a number of financials over the last 20 years, and I'm going to reveal why AI companies need fundamentally different financial frameworks than SaaS does. And why do a lot of head of finances, CFOs get this wrong? I'm a finance exec. I've done a number of valuation studies over the last 9, 10 years, and both for traditional SaaS and lately the AI companies. Through comparative financial analysis, I've identified critical differences that most people miss. Differences that can make or break your fundraising and valuation. You know what those mistakes are? The biggest mistake I see, AI companies trying to force their financials into SaaS frameworks. It does not work and is costing them millions in valuation. So what is this illusion, this cost structure illusion that I'm talking about? Let me start with the biggest difference. The AI companies have fundamentally different cost structures that break traditional SaaS accounting. There is a hidden infrastructure cost that you have to be aware of. Traditional SaaS company cost structure, you have software development, which constitutes 40 to 60% of the expenses, and you have sales and marketing 30 to 40%, maybe G&A about 10 to 20%. AI company reality from case studies that I've analyzed, the model development and training alone is 25 to 35% of the expenses. The inference and computing cost, 15 to 25%. This goes in COGS, not R&D. What about data acquisition and labeling? That is about 10 to 20%, also going into COGS. There's traditional software development, 20 to 30% in there. Sales and marketing is about 25 to 35%. So there's this gross margin trap. I studied an AI company claiming 85% gross margins, and when I dug into their actual cost allocation, they put model training costs in R&D instead of COGS. Cloud computing for inference was an infrastructure expense. And now the data labeling costs, the annotation services were in product development. So once you adjusted their real gross margins, 55%. So there's a scaling cost problem, and SaaS companies have near zero marginal cost. AI companies don't. Every new customer in a traditional SaaS company, they add minimal server costs. However, every new customer in an AI company, they add additional inference computing cost. There are more data processing requirements. And the potential model retraining needs, that is there as well. There are higher cloud infrastructure spending. I've seen these AI companies where customer growth directly correlates with infrastructure cost growth. And that could be terrible unit economics hidden by all these accounting shenanigans. There are also revenue recognition differences that you need to be aware of. The second major difference is on revenue recognition. AI companies often have hybrid revenue models that complicate financial analysis. Usage-based revenue complexity. In traditional SaaS, you don't have that. Your $100 a month per user recognized monthly. AI company reality, 0.10 per API call, $50 base fee plus professional services. So if you start breaking down this case study, customer is paying $50 a month base fee recurring and uses 10,000 API calls at 10 cents each, $1,000 monthly variable cost, needs 3 months of implementation services, $45,000 one time. The total contract value is about $78,000 over 12 months. The recurring portion is only $12,600. The variable portion, another $12,000. The services portion, $54,000, 69% of total. This looks nothing like traditional SaaS metrics. So there is this professional services dependency that most AI companies have. I've analyzed about 40 to 70% professional services revenue in the early stages, and there are several issues that I find. There's a revenue quality issue. Services revenue gets 2 to 4x lower valuation multiples in software revenue. There are scalability issues. Services don't scale like software. There's gross margin pressure. Services typically have 30 to 50% margins versus 80% plus for software. Then there's a consumption model challenge. AI companies often charge based on API calls, like I mentioned, on the data volume that is being analyzed, on the processing time or the compute units now, outcome-based pricing. This creates revenue volatility that traditional SaaS really don't have. The customer usage can vary 300% month to month, making forecasting hugely difficult. So what are the unit economics and metrics? Traditional SaaS metrics don't work for AI companies. Here's what you need to track instead. Cost per prediction divided by maybe the transaction. Instead of customer acquisition cost, track what is the cost to serve each API call? What is the margin per transaction processed? What is the infrastructure cost per customer? I studied an AI company where their cost per API call was 0.08, but they charged 0.10. That's only 20% gross margin per transaction. Terrible compared to SaaS. And you also have to look at the customer cohort behavior. The AI customer behavior is different. The usage typically increases over time. It's good for revenue, but costs also increase with usage, which is bad for margins. The churn patterns are less predictable. Customer expansion is based on usage, not seat growth. So there is this impact on the model, and which is unique to AI. The model performance directly affects unit economics. Better AI accuracy, higher customer satisfaction is lower churn. But also better AI accuracy is more expensive models and higher cost. I've seen companies spend $200,000 improving the model accuracy by just 5%, reducing the churn by 15%, but increased inference cost by 30%. Then there are capital intensity differences. Traditional SaaS companies, they can scale revenue with minimal additional capital investment. What about AI companies? They often need significant ongoing investment. They need investment in model improvements and retraining. They need investment in data acquisition and quality. They need investment in infrastructure scaling. And they also need investment in R&D. This makes AI companies more capital intensive than traditional SaaS, affecting return on investment capital calculations. So what are the implications on valuation investment? These differences are creating major valuation challenges. There's a revenue multiple compression. Traditional SaaS companies, they are valued at 8 to 20x revenue multiples, whereas AI companies with very high service mix, 4 to 12. AI companies with pure software, 6 to 15. The services component and the variable costs, they drag down the multiples significantly. And then there are different growth metrics. Instead of traditional SaaS metrics, investors are focusing on the backend, API call growth rates, revenue per API call trends, model performance improvements. What is the strength of the data moat strength, I'd call it. And they look at the profitability timeline. SaaS companies can achieve 20% plus net margins at scale. AI companies often plateau at 10 to 15% net margins due to these development costs and infrastructure scaling requirements and these data acquisition expenses. Investment requirements in SaaS companies can often reach profitability with initial venture funding fairly quickly as compared to AI companies. They typically require multiple rounds because of the longer development cycles for AI models. They need higher ongoing R&D requirements. They need more capital-intensive scaling. And then there's obviously the competitive pressure requiring continuous innovation. You also have to consider the due diligence differences. Investors evaluating AI companies, they need to examine model performance benchmarks and the trends. They need to look at the data quality and then look at the acquisition strategy. What are the true cost allocation, not the SaaS style accounting? What about infrastructure scalability? They have to have plans. What are the competitive moats beyond just software features? So AI companies are not just SaaS companies with AI features. They are fundamentally different businesses with different cost structures. They have different revenue models, they have different scaling characteristics. CFOs who try to force the AI company financials into SaaS frameworks, they end up with misleading metrics, they end up with incorrect valuations, and they end up with failed fundraising attempts. The key is building financial frameworks that reflect AI business realities, variable costs, hybrid revenue models, capital-intensive scaling. Get this right, and you will build investor confidence. Get it wrong, and you will struggle to raise capital, regardless of how good your AI technology is. So it is very essential for you to differentiate between the AI model and the SaaS model. And there are no lines that blur the differences. Those are concrete economic models that are completely separate from one another. Once you keep that in mind, then things get a lot easier in terms of building the financial framework. Thank you. Bye-bye.